The crypto market operates 24 hours a day, 7 days a week, generating a landscape of constant, erratic price swings. Many retail traders approach this environment by buying and holding the actual tokens on an exchange, a method known as spot trading. When the market crashes, these traders are trapped holding depreciating digital assets while their capital bleeds out. CFDs let you speculate on price without owning the coin, detaching from the physical asset. This provides leverage, using a small margin to control a position 10 times larger. You can also short the market to profit directly from a drop. Navigating crypto requires agility. By abandoning the requirement to statically own the asset, traders can deploy directional speculation to capture value in both rising and falling markets. The assets in this space behave differently based on their structure. Bitcoin serves as a relatively stable foundation. Ethereum moves based on its network upgrades, and altcoins act as high-risk, high-reward vehicles, prone to massive short-term swings. Generic trading tactics break down under these conditions. To extract profit from rapid price movements, you need specialized, calculated strategies. This chart shows a classic trend-following setup. We see a price line testing a flat horizontal ceiling, known as resistance. When the momentum finally builds enough pressure, the price violently pushes through that boundary and accelerates. The execution of a breakout trade happens right here. By identifying the exact structural ceiling, you can execute a long entry the moment the resistance breaks, capturing the momentum of the upward surge. But markets don't always trend in a straight line. Often they chop sideways in a defined channel, requiring a shift to range trading. This animated diagram shows a sideways price line measured by Bollinger Bands. Bollinger Bands are a technical indicator featuring a simple moving average and two standard deviation lines that physically expand and contract to visually map market volatility. By mapping these outer boundaries, the execution becomes systematic. You buy when the price strikes the bottom band and sell when it hits the top band. Unpredictable market noise is reduced to measurable parameters, giving you precise instructions for entry and exit. Applying leverage to a volatile asset magnifies the danger. A basic stop-loss order will be triggered constantly by normal fluctuations, unless backed by mathematical structure. This diagram shows a visual equation for dynamic position sizing. It calculates the specific volume of a trade by balancing a strict 1 to 2% account risk limit against the distance of your stop-loss. The core mechanical rule is strict. If you widen your stop-loss to survive extreme volatility, your overall position size must shrink proportionally to keep your dollar risk identical. Dynamic sizing protects the account, but leveraged traders also have to manage a hidden operational cost: funding rates. Funding rates are periodic payments made between long and short position holders to ensure the CFD price stays anchored to the actual spot market price. These fees transfer continuously based on market sentiment. If the market is aggressively bullish, traders holding long positions will automatically pay fees to traders holding short positions, and vice versa. Surviving long-term in crypto CFDs requires calculating these sizing equations and funding mechanics before a single order is placed. Technical charts offer a map, but macroeconomic news, interest rate decisions, or sudden regulatory bans can instantly hijack the price action and override technical indicators. When global events trigger a spike in volatility, speed and reliability of your trading infrastructure determine whether you capture the move or suffer the loss. Executing leveraged mechanics during a market shock requires flawless data delivery. Platform latency issues, sudden system crashes, or suddenly widening spreads during these precise moments can wipe out an account in minutes. The FXNX platform provides an institutional-grade environment for advanced CFD mechanics. It ensures precise entries with zero-pip spreads, flexible leverage, and automated negative balance protection. To profit from extreme volatility, you have to ignore the hype. By applying strict mathematical risk limits, executing specialized technical strategies, and relying on a premium broker, ultimately, you can tame the digital frontier.